Hello, I'm Barkley Roper with Tiger Capital Management, a registered investment advisor in the state of Idaho, bringing you your weekly trend update. It's great to be here today. And last week we talked about the cumulative returns on the S&P 500 and what the cumulative returns were during different bull and bear markets over the last 20 years. This week I told you I was going to bring the data that explains the compound returns over the 20, 10, 6, and 3 years that have just occurred. And so I wanted to share that with you, and I wanted to share it with you in the context of a buy and hold strategy versus a long-term trend following strategy. Remember that a buy and hold strategy means that you would have bought, if we're looking at 20-year period, you would have bought 20 years ago and held it through all the up and down markets until today. Versus the timing model, you would have held, hopefully, during the bull markets, then moved to cash during the bear markets. And so we're going to look, I'm going to go over those numbers right now. So if you were to have bought and hold the S&P 500 for the last 20 years, you would have had a compound return of approximately 6.47%. Versus the timing model, you would have had a return of 9.3% compound return. So that's about a 3% spread between the buy and hold versus the long-term trend following method. Over the last 10 years, and let's go ahead and go to this chart real quick, just so I can show this to you. But over the last 10 years, you would have returned, using the buy and hold strategy, 4.95%. And the long-term trend following strategy, you would have returned 7.98%. So that's also approximately a 3% spread. And during that period, you would have experienced 1, 2 bull markets and 1 bear market. So that's important to take into consideration. And then over the last 6 years, using a buy and hold method, you would have returned 1.72% versus the timing method or the long-term trend following method, 7.14%. So that's a huge spread, over 5% right there. And the reason for that is because just in the period of time that we're looking at, we went through 1 bear market and 1 bull market. We would have entered right here at the top, and a buy and hold investor would have held on through this huge down period, versus the long-term trend follower would have exited somewhere around here and preserved their capital. Now, the last 3 years have been very good for buy and hold investors. The compound return over the last 3 years has been about 15.88% versus the timing or long-term trend following method, about 10.08%. And the reason for that is because all we've experienced over the last 3 years is a bull market right here. And typically when we want to look at these studies and compare numbers, we need both a full market cycle, which would include a bear market and a bull market. For the last 3 years, all we've experienced is a bull market, and so the compound returns using for a buy and hold strategy do look much better. But we'll have to wait and see how they look through the next bear market. So the one other thing I wanted to point out, if we go back to the 20-year compound returns, something that I'd like to talk about next week is typically when you want a higher return, you have to take more risk. And so in order to get the 9.3% compound return using the long-term trend following method, did we take more risk? And so I want to talk about that next week. But for now, let's go to our trends. So let's go to U.S. stocks. Here we are with U.S. stocks. We have the price as of today right here, just barely below the 50-day moving average, still well above the 200-day moving average. And so we are in a confirmed uptrend for U.S. stocks. Foreign stocks today, right here, price is still above the 50-day moving average, also above the 200-day moving average, and so we're in a confirmed uptrend. Going on to real estate investment trusts. Here we are today, and these have not been behaving the way I'd like them to. I want them to go back up into an uptrend. but we're teetering right on a downtrend. Yesterday we had a horrible day in above average volume. The only good thing about yesterday is that the closing price ended off the bottom of the range that day. But we're still right here at this support line, waiting for it to break below that. If it breaks below it, we'll probably be in a downtrend. But for now, we're still in a confirmed uptrend with real estate investment trusts. Going on to commodities, we see that last week commodities popped right above the 200-day moving average, but then have fallen below again. So we're still below the 200-day moving average, and the 50-day moving average has not crossed above the 200-day, and so we are still in a confirmed downtrend for commodities at this point. And then last, we have bonds, and bonds also are right at this this support level, and we can easily see that the price is well below the 50, well below the 200-day, and so bonds were still in a confirmed downtrend. Let me just go over that one more time. U.S. stocks are in a confirmed uptrend. Foreign stocks in a confirmed uptrend. Real estate investment trusts, we'll say, are still in an uptrend. Commodities are in a confirmed downtrend, and bonds are also in a confirmed downtrend. So that wraps it up for today. I'm Barkley Roper with Tiger Capital Management, bringing you your weekly trend update. If you have any questions or comments, please feel free to give me a call or email me. Thanks, and we'll see you next week.